Phillip Streible joins us now, one of our regulars, Chief Market Strategist at Blue Line Futures. Phillip, great to see you. You have some thoughts on commodities for the week ahead. Oil hitting $70 US today briefly. You see prospects for a blow-off top, as you call it, at 72 to 74. What does that mean? What would a blow-off top be?
It means where we would accelerate higher at a rapid pace. See, what we're starting to see is that road traffic is at pre-pandemic levels, not only in the US, in the UK, but also in Spain. And we believe that this trend is going to continue as the COVID vaccine rollout continues, and it's really gaining momentum. COVID cases in the US are down to about 22,000 cases a day, which is about equivalent of to when the epidemic had started back last March. So we're continuing to see the supply get outstripped by demand, especially in the U.S. We're seeing about 479 million barrels versus the 5-year average 493 million barrels. So we're running a supply deficit right now.
And you think, I think your argument is that OPEC Plus is probably going to have to jack up production more than proposed?
Yes, they will, especially in August and in the back half of the year. There's too much pent-up travel demand that's just out there that people, especially from airlines and cruise ships, as soon as those get going, you're going to really see that supply stripped down quite a bit. The demand is accelerating quite high. OPEC Plus, their production is only going to start to increase in July. They need to look farther out to the back half of the year. They want those higher prices. They want prices in the high 70s, mid to high 70s, in order to, when they do increase production, it will only gradually take prices lower. See, if they start in the 60s, they're probably going to end up 65 to 62. They've got to wait till we get into the 70s before they start producing. That way their profitability is higher.
And sorry, we're tight for time, but you think if oil does get to 72, 74, it could jump higher from there?
Well, if you see the gasoline demand start to outstrip, you'll see that. However, we do believe 72, 74 is a conservative price target for oil.
Okay. Copper, you are long copper, but you warn that a slowdown could be a headwind for prices. Now, you call it a small headwind. Wouldn't it be very bad for copper if China was to slow down?
China's economic data has been rolling over. It's merely consolidating. Globally, though, we're still going to continue to see demand pick up. Many of the emerging markets, Europe, other big users of copper out there, they still haven't got going yet. So you're seeing quite a bit of demand pick up, especially inventory side. People are still trying to struggle with the supply chain breakdown. You're seeing too much demand for goods that utilize copper, and you're going to see one more push up on copper. We think 475 will be an upside target to move up there.
US dollar. Do you think the US dollar will go on weakening, Phillip?
Yes, 89.20 would be the downside target on the dollar. Any rally that we get, we've been active sellers on the US dollar index. That ADP report we saw last Friday, that was a perfect opportunity. We saw a green shoot in the dollar. However, we don't see, the jobs picture. That's when the Fed is going to raise rates. That's the next aspect. It's the inflation data and the jobs data. They're still 12 to 14 months out, especially if they're only going to be creating about 500,000 new jobs per year in order to meet that goal that they had. So we got about a 7.6 million job shortfall from pre-pandemic levels.
That's interesting. You're talking about the US dollar index, I think, Phillip, and right now it's just below 90, but you see it slipping to around 89.20.
Yes, absolutely.
And what about US budget wrangling? I mean, is that bearish for the US dollar? I presume it is. It creates uncertainty. I don't know what it really means for interest rates, though, when the Dems and Republicans can't agree on the budget.
Yeah, the yield curve, the 10-year yield, it's been consolidating. That's been, the biggest full momentum for the gold market. We do believe that budget, the wrangling of that, that's going to cause gyrations in the market. However, the Fed's going to continue to remain supportive. What people don't watch, though, is that repo window where they do suck some liquidity out and some excess funds out of the market. But we believe that yields will rally into the second half of the year. That should act as a small headwind for gold at the moment.